Good afternoon. We're going to be analyzing some multifamily real estate. I found this multifamily apartment complex up in Washington, in Grandview, Washington. It's this older brick style single level property. This property here has 6 units all on one level. Let's take a look. Okay, so this is Grandview. It's in Yakima County. So this is the Columbia River. We have the Tri-Cities over here. Kennewick, Pasco, Richland. Grandview's this way. I want to see what that neighborhood looks like. So I'm going to do just a quick street view. Take a look at the property. This looks like a nice neighborhood. That doesn't look bad at all. Awesome, 60K reduction a month ago. Investment opportunity in the heart of Washington's Wine County, Grandview, Washington. Nestled in a mature landscape, this brick sixplex and additional one bedroom, so 300 square foot bungalow, offer a cozy feel in a neighborhood of surrounding single family homes. Located a couple blocks away from Safeway and an elementary school, this property offers 6 two-bedroom, one-bath units plus one separate and a 3/4 bath bungalow. 4 of the 7 units are currently rented with long-term tenants. The rented units have newer hardwood surface and kitchen updates in the past 10 years. The other 2 units and bungalow need a bit of work. Home is priced to reflect those costs. Owner pays water, garbage, and sewer as there is only 1 meter for all 7 units. That helps us figure out how much we should be spending on utilities. Call your favorite realtor today. So we're going to analyze this property. Pretty straightforward. Let's take a look. So there are 13 bedrooms, which makes sense. The 6 units have 2 bedrooms and then the bungalow has 1. And there is parking. It's on just less than a half an acre. And it has a patio with porch. It's a multifamily, obviously. Built in 1950. I will obviously need to go and do repairs on 3 of the units, which will cost a couple $1,000s. But I mean, that's not a bad trade for 7 units. Okay, going down to the financial and listing details. So we know exactly how much the tax is for the year and what the actual rents are. That is incredibly low. That's incredibly low. I guess it makes sense because there are 4 units rented. But if it's 2,800 divided by 7, I mean, really you're bringing in $400. This isn't a fair trade because they're mismanaging this property pretty bad. I mean, yeah, okay. Yeah, so there'll be quite a bit of work to get them up and running. But I mean, if you are willing to put in the work, that's something to think about. And there's the bungalow. Yep, a lot of work to go in there. There's opportunity in everything. Somebody's problems are your profits. And so if you're willing to go in and put in the work, you can get some good returns off of this. I'm going to go find and see what the rents are in this area because the per rent, I guess for the 4, $700. So let's go to Rentometer real quick. Rentometer. Let's go to Rentometer, put in the address. It's 2 bedroom, 1 bath, apartment, and check the rents. Okay, so 25th percentile. So that's as moderate. So about the median is 1,250. We can probably get that once we get the property stabilized. But let's say 1,000. Let's say $1,000. Interest rates. I was talking with a bank the other day, and they were saying high 7s, low 8s. So 7.75 for interest rates. A down payment, I can probably do 30% cash on cash return. My investors want a 10% cash on cash return. The buyer is going to be paying the buyer's agent fee. So I'm going to bake that into the sale price of 2.5%. Closing costs, an additional percentage. And there are 7 units here. Expense fees, I will be managing it myself. Oh, actually, so for expense fees, I will probably be having somebody else manage it for me once I get the properties up and running. And so let's just say, I'm going to say about 50, just to, because since I'm paying all of utilities and management fees, we can go in deeper onto each and every single expense line. We know what the taxes are, so we can get a better estimate. But let's just say 50 right now, and then normally it's about 25%. So based off of this, we should be paying $64,000 a unit for a total of $450,000 for the total value, and then we take away closing cost. We should offer $435,000. They're asking for $615,000. They think that they're trying to take as much upside as possible. That means you have to work harder and longer for less return. But they're trying to take advantage of the fact that there are 3 unrented and unfinished rooms that will need substantial work, like tens of thousands of dollars, most likely, getting it up and fixed. And they're trying to take all of that upside off the table because of their neglect. Regardless of their neglect for the property, they did not fulfill their duty to the tenants. They did not fulfill their duty to the property, but they're trying to capture as much of that upside as possible. And that's not right. And so what is right, what the right price is, with an expected rent of $1,000 per unit, we should offer $450,000. And we can go in and explain why. We can give them the like if we take, for example, what our offer is, not the 450 but the 435. If we take that, put it in an IRR calculator, we're offering 435. I think I saw down here it shows that they bought it for $200,000 back 10, 11, 13. 10, 11, 2013. So they're, even with this $435,000 offer, they're making a 7.3% IRR. They're making a 7.3% IRR, which for them, that's great. So I would offer them this. I would go through, but I mean, this seems like a fair offer for this specific property. Yeah, let me know if you have any questions. I'd love to talk more about what you're working on. So hit me up. Let me know if you have any questions, comments, or concerns, and I will see you in the next one.